Hey everybody, welcome to our webinar today. Today, we have a real treat for you. The tax and estate planning team is going to be on with us today. We've got Frank Abate joining us, Brad Hyde, and Daniel Bolofsky from BMO Insurance. Frank is going to talk about, you just sold a big life insurance policy. It's a big case and it's in force. It's a couple of years later. Now what? Frank, I'm not going to waste any time here. Without further ado, I'm going to hand it over to you. I know you've got a substantial amount to get through today, and then we got followed up with Brad Hyde. Today, it's all about farming, I guess, is it?
It is. It happens that my case that I'm going through is a farming case, and I was pleasantly surprised on the agenda that Brad will be talking about the rollover rules. He'll be doing all the heavy lifting while I just do some of the easy stuff. And it's interesting. That's a good prelude into this presentation because if you do, as an advisor, if you do a good enough job on the upfront, on the sales end of it, you'll find that the years that follow are not difficult. And what led me to put this together when you asked me to speak, Don, is I had just gone through this 4 years in, and client says, "Hey, I really want to look at the presentation that you originally used on me to help me understand why we were doing insurance." So fantastic for me to have done that presentation. And what the audience today will see is what had to be done to tweak it. So without further ado, I'm going to get into the presentation because I can be long-winded. Please, as I'm going into this, cut me off when I have to, okay?
Okay.
So you settled one of your largest cases ever. Time to celebrate? Yes, absolutely. Celebrate. Large case space is not an easy one. Go into the large case space knowing that that large case will take time. When it happens, celebrate it because you've done something very good for your client. In these large cases, we're solving problems. We're offering solutions to their problems. So yes, let's celebrate with the client that they did something good for their family. But the work is not done. So what happens now is on an annual basis, you have to be cognizant of addressing, are we still where we suggested that we'd be? And what is it that the client's going to want from us as reassurance on an annual basis that everything we've put in place is still going to solve that problem that we originally solved for? And what I find is, and now I'm into this 7 or 8 years now. I started in 2018, so yeah, this will be my 7th anniversary in July 1st with IDC. Prior to this, I did some roles in the tax and estate at Canada Life. But what you find is that if you've done a good enough job at the front end, if you've done a proper job at the front end, sales process, I call it. And Don, you've heard me speak about this over and over again. A sales process is not a fact find and producing illustrations. A sales process is 1, 2, 3. This is the way that I go through the process. And I'm going to, instead of trying to work my way through it, I'm going to go through each and every step. On every case I work on, this is what I do. So number one, I have an introduction meeting with the client. Regardless of if you know the client and you've had so many dealings and you say to me, "Hey, Frank, I'll furnish you with all the facts, just prepare a solution," that doesn't work. I've been at this long enough to know that I need that interaction with the client. Yeah, the interaction will be reduced. The time spent will be much less if you've got 99.9% of the facts. But I need that discussion. I need what I see right now. I see Don on the screen, and I need that casual conversation. You've heard me say this, Don, over and over again. I need to have that casual conversation so that I might open up a different set of questioning than you've ever addressed.
Right.
So give me that, and do not say to me, "Hey, Frank, it's going to be a waste of time," because I'd say out of 1,000 of those meetings, maybe once I've ever had someone say that was a waste of time. Of course, I'm being a little bit sarcastic there, but there's few times that they ever say it's a waste of time. After that, I take my facts and I prepare a deliverable. And to me, the deliverable, the PowerPoint presentation that I prepare, is perhaps the most integral part of the sales process and the follow-up process, as the audience will see in a few moments. And that PowerPoint presentation, the intended audience is the client, not their lawyer, not their accountant. It's the client that has to understand this. It's the client that has to engage and decide whether or not this makes sense. Use pictures, use spreadsheets, make sure that they understand it. After the presentation is shared with the client, we basically tell them digest the material, and if you need to, if you want to, we encourage you bring your tax advisor, your accountant or lawyer in at this stage, and let's not bring them in too soon. Let's make sure that the client likes it before we bring in accountants and lawyers. Have follow-up meetings, as many as we need. I've had follow-up meetings. If I said 20, yeah, it's not unheard of to have 20 follow-up meetings in these large cases. And again, that PowerPoint that I prepared is now what I call the playbook. It's a rule book, it's a roadmap, whatever you want to call it. So what has this created? I'm repeating myself here, but it's created structure and a reference point for the following years for the client. It's documented our discussions at the time that we've had the discussions, and it gives expectations to the client of what it is that we're achieving with this insurance solution. 10, 20, 30 years from now, even next year, clients will hear from them that they don't remember why they bought the policy. No problem. Let's pull out the original presentation and we'll walk you through why we bought the policy to begin with. Do we go through this extensively on an annual basis? And my answer is no, absolutely not. We're not pulling out that PowerPoint presentation every year. That would be overkill. If the client wanted it, we'd do it. How many clients do you think want to see that PowerPoint presentation every year? I'd say absolutely none. But they know it's there. Their accountant knows it's there. Their lawyers know it's there. So we don't know when, but like in my situation, 4 years later, it gave us an integral tool to have our review and address the issues that had come up 4 years post-sale. So instead, go through your same annual review process that you would if this wasn't a large case, without having to include the PowerPoint presentation. As the client needs, they'll ask for that refresher. So I'm just going to pivot for, I'd say, 3 minutes, 3, 4, maybe 5 minutes. And the reason I'm going to pivot is because I don't know why. I guess it's easy for me to say because I deal with so many IFAs. But when it comes to IFAs, advisors think, oh my God, the amount of work that we're going to have to do on an annual basis is going to be through the roof. And the answer is absolutely not. This is very simple. The annual requirements for an IFA, what we have to do as advisors, is extremely simple. Upfront, absolutely. There's a lot of legwork. And I'm the big promoter, as anybody in this space would be. It's not rocket science, but I always say, immediately when we put that app in for life insurance, let's get the underwriting going for the IFA. The work is upfront. The follow-up is very simple. And I thought I should address this because so many advisors have that misconception that there's a lot of work on an annual basis. So why is it so difficult up front? Well, because they're underwriting a loan. And the fact that we're giving a policy as security does not negate their underwriting process or procedures. They need to satisfy themselves that the client has the ability to repay this loan. So they're going to go through their underwriting procedures, no different than any other loan. Fantastic that they have such a tangible asset and that they'll leverage at such high percentages, 100% of cash surrender value, projected cash surrender values. That's fantastic. But we have to satisfy the underwriting requirements in order to get the loan. So please do not assume that it's a slam dunk. I'd say over my career, I've had a couple where, no, they just didn't get that IFA loan. They got denied. So this slide is pulled from an actual email from a banker I think this case was with Scotiabank. I do a lot of work with Scotiabank. I like their process. I like their turnkey solutions that they offer. But this is exactly me pulling out of an email what it is that they're looking for. So most current 2 years of notice of assessment and full T1 general, 2023 and 2024. This is regardless of if it's a personal IFA or a corporate IFA, they want this. Copy of driver's license, that's fine, that's very simple. A filled and executed personal statement, which they had attached. What this is really a personal net worth statement. They want to know about your personal finances and most recent financial statements for the corporation. That's very important. We have to show the financial statements of the corporation show that these people have cash flow and they have the ability to finance interest if need be. And of course, for the insurance portion, copy of the in-force or new policy illustration from the insurance provider, policy start date, and the premiums have to be set to annual, not monthly. Here, I'm going to go on my soapbox. Those last 3 points, what they indicate is that the policy has to be in force before any lending happens. So I want to be clear on that. You're not getting the loan and then the policy gets settled with the loan proceeds. You get the policy settled with the client's own cash, and then it takes, usually I tell the clients, a week or two for us to get the assignment on that policy, and then the bank will extend or they'll advance the loan, but it happens after the fact. And that's very important because I can't tell you how many times a client thinks that the first premium and every premium will be coming from the bank financing. That's absolutely not the case. It has to come from their own coffers. And then, of course, the bank will loan against that.
Frank, just a question here.
Yeah.
What is the loan rate that what's the typical interest rate on the loan?
So the bankers are usually looking at the size of the deal. I'd say prime is a good indicator. And if you think about it, prime is a good deal in the sense that it's a secured loan.
Right.
In the past, I was able to get prime minus, not as much now. I don't know if anybody else in this space is able to get prime minus a quarter or prime minus a half, but I always think a good starting point to promise your client is prime. I find that prime is usually achievable from one of the banks. I think most people here are going to be very pleasantly surprised at how little we need on an annual basis. Because, first of all, the pre-approvals for these things are such that for 5 years, they don't want to see you again. In terms of finances, you're basically approved for a 5-year span. And other banks might have longer. I know with Scotia, who I do a lot of deals with, you're pre-approved for 5 years. So again, here's the pull from an email where the banker was asking for their annual supporting documents. So first thing, updated policy summary for life insurance policy numbers. Here I used a couple of policies to secure an IFA, and we want to see that premiums were paid. Again, year 2, premium goes in from the client, premium gets reimbursed or gets loaned back after the client actually paid the premium. And I'm very adamant about saying that. I'm very adamant about making sure people understand the premiums are coming from clients, and then the bank is lending against those cash surrender values that were paid from the premium.
Are all banks familiar with this strategy, or are there particular banks that we should be approaching?
That's a really good question. I worry when someone says, I'm going to take it to my bank. I've had people where I've approached a private banker. I don't want to name the bank. Well, I could say it was RBC. I approached the private banker and I said, listen, if you don't mind, I'll take this to a bank that has the process in place. And basically what happened was the private banker was okay, and I promised them that we wouldn't steal any other business. Right. So I say that because you want to make sure that you're using a banker that is familiar and has a back office and has a structure in place to do IFAs. So the simple answer is that not all of them do it. They may attest to do it. Just make sure that they have a structure and a process for IFAs particularly.
And if you were doing that, would you recommend, are there a couple of banks that you would recommend? Like in our experience now that we've been doing this for a few years now, in your experience, what are the banks that are a little more friendly towards this strategy?
I don't want to comment because I think all the banks are good. My response will be I've got a good relationship with that Scotia banker. So we have a good working relationship and their back office and their structure works for me. So that's why I prefer it. I wouldn't say one is better than the other. It's a tough question. I've done Manu Bank, and again, Manu Bank is very swift. I've heard very good things about Duca. I've heard good things about Equitable. But I think just like how we choose insurance companies sometimes, it's based on our relationships. And if everyone's offering good service, you go, or a good product or a good solution, you go with where you have a relationship. Enforced policy illustrations, again, for the same two policies, because we use two policies here at current -1. So they want to see the enforced. Why do they want to see the enforced illustration? Because they're lending against end of year values. So far, I have to furnish policy summaries showing the premiums were paid, enforce illustrations, and pay an annual fee. This one was a Manu Bank request because I know the fee was about $500. So those three items is all we need on an annual review. Is an advance required this year? And that's a good thing. Is an advance required? If we don't need the money, if the client doesn't need the borrowing, they're not going to extend the extra loan. We don't have to pay interest unnecessarily. But I wanted to put this slide in to kind of quash all those thoughts that, oh my God, it's going to be overwhelming every year for an IFA. The overwhelming part is the part that I talked about earlier, was to get the loan. That's the overwhelming part. This is the part that isn't overwhelming, but that's the one that requires work. The annual reviews, IFA, absolutely simple. Absolutely simple. So I'm going to keep pressing on. Don, I think that I covered the IFA good enough.
Just a couple more questions now
Okay.
because we've opened up the Pandora's box here. Just
Worries.
I see somebody here is thinking there's still some confusion, obviously, by this question. I'll refer to it. Can I do an IFA with term insurance?
No. What are we going to lend? What are we going to lend against? What's
So
the?
no lending. There's no facility to lend against the death benefit.
Yeah.
Yeah.
That's right. Yeah, they're strictly lending against cash surrender value.
What happens if the client decides 3 years down the road, I want to cancel I don't need the IFA anymore. I want to cancel it. Where does
Yeah.
the money come from to pay off the loan? Is it the cash surrender value from the policy, or where is it coming from?
Well, that's key. We are not using the cash surrender value from the policy because, of course, that would lapse the policy. We'd be doing partial surrenders. What I've had in the past, and what this gentleman that I'm going to get into this case, he's got cash flow. He's a farmer, so he's cyclical. So in his flush months, when he's flush with cash, he pays down the IFA, and in the months where he's cash poor, he uses the IFA. So basically, he uses the IFA, and in his words to me in this annual review, he says, Frank, this IFA has taken out ATB as my line of credit. ATB being, from what I understand, his banking credit union that he had. He says, this has taken them out. I don't need them anymore because the IFA has provided that cyclical ability for me to borrow, repay. So he's a good example. I like IFAs like this.
Okay.
Is this the typical? Probably not. Most just leave that outstanding balance. And perhaps, here's what I say. If you're taking an IFA, it means that you're buying another asset, an investment producing asset, or you're putting it back into your business. But if you're buying an investment producing asset, let me use private mortgages, for instance. People that do private lending love doing this, right? They put money into a policy, borrow it back using the IFA, and then they go and lend it out to a borrower. When that loan gets repaid, they can take that money and repay the IFA. So yeah, there's so many different ways to slice and dice it. They could repay it, or they can keep it on outgoing for eternity.
So you've answered one of the questions that came up after that. So two questions: is Manulife pay to 100 still one of the preferred highest cash surrender? Does it generate the highest cash surrender value? So when you're doing the illustration, you're looking for the highest performing, cash buildup in the insurance policy, of
Yeah.
which, I mean, you can't depend on the dividend necessarily being there 5, 10, 15 years down the road to be competitive, but they're all pretty competitive right now, are they not?
Yeah. I wouldn't. I'm not going to use this presentation to say which companies.
Carrier, fine.
This one was an equitable life case.
Yeah,
I've done Canada Life. I've done them all.
yeah.
So I'm not going to take sides on who you should be using.
Yeah, and we're seeing a lot of the companies coming out now persisting with their current dividend, so they're going another year on the current dividend scale, so that's good. The last question here on the IFA, and then we'll move on from this, Frank, is CRA okay with IFAs?
Well, yeah, if you're doing them in a fashion that it's borrowing back into the corporation, so we're not doing one of these things that I'm not comfortable with, where we're using corporate money and then we're doing an IFA personally to try to bypass tax and strip money out.
Mhm.
I think that I see Brad nodding, so I think we'd agree if you go by the book and you do everything in a fashion that doesn't look like it's a tax scheme. We're not trying to do anything.
Right,
I would say it's no different than if you had a building in your corporation and you leveraged your building.
right.
You leveraged the building and you took a line of credit back into the corporation. So why would a corporate asset called life insurance have the CRA up in arms regarding this?
Okay, perfect.
And accountants, they like it when we show them the plain vanilla, right? Just think about accountants and lawyers. They're very conservative by nature. So I'm not into showing any tangents or pivot. If that's the way you want to go, that's not really my forte or my comfort zone.
So we're not borrowing it to invest in comic books. Is that what you're saying?
In comic books?
Yeah, they use it for language training in third world countries where they
Oh, yeah. Or buying arts or anything like that.
yeah.
No,
Okay,
absolutely.
let's move on.
Okay. So I promise, Brad, if I steal time, it's 5 minutes.
Oh,
Okay.
it's all good. It's all good, Frank.
All right, excellent. So this policy settled in 2021. Sizable annual premium shown at the time as a offset at year 10, $250,000 of annual premium. I'll tell you that, but here's the nitty gritty, and here's the solution. The important part of why we did what we did, and why life insurance was integral. Estate planning for a farmer. We're going to call him Farmer Bill in Alberta. Bill has a son active in the farm. He's on his second marriage. He's married to Mary. Mary has 3 daughters, so they're Bill's stepdaughters, and they want nothing to do with the farm, right? So Brad and I and anybody in this space, Don, all of us in this space get it.
Mhm.
This is the ones that I love to work on because insurance is the hands down best solution to solve for what I'm going to say the problem is. But already Don and Brad and most of you should know what the problem is. 3 daughters not active in the farm, son active in the farm. Okay. Bill and Mary have a 70-30 ownership, common shares in the farm corp. Back in 2021, when I met them, that was the structure. Going forward, Bill wants the growth in the farm to be split 50-50 between him and Mary. On Bill and Mary's passing, the shares of the farm corp will go to Bill's son. Makes sense. However, Bill is adamant that the daughters are going to be paid out for Mary's share. Right? Mary has value in this farm, and she should be able to leave her daughters her 50% value plus the 70% that it's already grown to. So I'm notorious for doing this. I'm notorious for showing pictures to the client. And it's amazing how many times they don't see this from their own accountants and lawyers. Or if they do see it, it's produced and not really understood by the clients. They don't have that ability to really understand what's going on here. But this is a simple picture. It shows Mary and Bill pre 2021 when they did a reorganization, but it was very simple. Mary had 30% of the common shares of Farm Corp. Bill had 70%. And around that time when I met them, Farm was worth 15.5% or 15.5 million. And they had done the right thing. Brad and I were talking about this. I don't know if it's right or wrong, but they had rolled over all the farm assets so that the Farm Corp owned all the farm assets. They used, of course, Section 85 to do the rollovers. but this was the structure. And then, of course, to achieve that 50-50 growth going forward, they did a freeze. And what happened was when we did the freeze at $15.5 million, 30% of $15.5 million means that Mary got $4.6 million pref shares, free shares. Bill got call it $11 million of free shares. 70%, 30%. I add those two numbers together, it equals $15.5 million, the current fair market value as at 2021. Now, new common shares are worthless, right? If all the value is in the pref shares, the new common shares are worth $100. So Bill wanted voting control. They set it up in this fashion, 51% new common to Bill. Mary took 49%. She had absolutely no problem with this. She was on board, and that's how they structured it. So here's what I show, and this is where all the action happens. The action meaning this is where the client wraps their head around what it is that's going to happen at death. Of course, I'm pulling out from all the buildup in my presentation, but I thought this was the key slide to show the audience today. And it was the key slide that I referred back to with Bill when I met him in February. So first thing, Bill says to us, let's assume I die, and I die at year 23. That took him out to roughly age 87. How do things look? And he says, by the way, I think that this farm will be roughly around 25 million when I die. Makes it very easy for a guy like myself, a guy like Brad, a guy like Don, when you have these facts and everything's been done. First thing, okay, we've determined $25 million of fair market value at death. So how much will the common shares be worth at death? Very, very simple calculation. $25 million, back out the amount that has to go to the preferred shares when we did the freeze. Remember, Mary got $4.6 million of free shares. Bill got roughly $11 million of free shares. So the remainder, I just subtract, and that tells me that the common shares are worth $9.5 million. Well, if the common shares are worth $9.5 million, then I got to make sure that I allocate those common shares. Half of that is roughly about $4,750,000. She's got 49%, so that's why it's at $4.655. So how much is being paid in? Well, I've got new insurance, meaning that these were the policies that we were selling, and existing insurance. Of course, I can't ignore that he's got permanent policies in place. So when I add the two up, the amount that's going to fall into Farm Corp is roughly about 8.7 million. I say let's round it up to 9 million. $9 million of cash exactly equals, I say exactly, but it's very close. We use a term called materiality. So the difference is immaterial for accounting purposes. We've got $9 million that will be used to basically take out the pref shares, take out the common shares, and by taking out the common shares, all the shares that rolled over from Bill over to Son, now that represents 100% of the shares. So I'm happy because Brad is nodding. I know Brad knows this space a lot better than I do in terms of farm rollovers and farm planning. The good thing here is that I just needed to use my insurance knowledge and work with their accountants and lawyers who really knew this farming space very good. So that's where we were at. And here's where we're at now. And that was all part of original presentation. So he reaches out in February 2025 and he says, guys, I'm a little bit nervous. He says, I want to do the right thing. And I don't think that we have enough. Music to our ears, right? I don't have enough. But all jokes aside, we said, okay, well, let's pull up the plan. And that's where I spent so much time at the beginning to say that those slides came up again and we just filled in the blanks. And you're going to see what we did in addition to filling in the blanks. But we basically said, he says, I want to see a fair market value of between 30 million and 40 million. I'm not a fan of doing 5 different scenarios and getting his head spinning. I said, hey, Bill, let's split the difference. Let's make sure that it works at $35 million, and then we'll see whether or not it could work for 40 million. He says, okay, that sounds good, Frank. So at $35 million, This is what I showed him. That original slide, I started with why we bought the amount we did. He says, oh yeah, I remember all of this. This made a lot of sense back then. Perfect. So we're going to fill in, we're going to drop everything in to that picture that you liked and made you understand. Again, let's go through the steps. Fair market value of $35 million. Calculation for common shares, 35 million minus the preferred shares tells me that the common shares are worth roughly 20 million. Of the $20 million, 10 million will go to Mary's common shares, and 10 million, of course, will be in Bill's common shares. So with a fair market value of $35 million, we need $14 million to pay out Mary and fulfill Bill's dream of basically paying out the daughters and treating them like shareholders, giving them their fair share. So now you can see I've got these question marks, right? Are we going to be able to do what you want, Bill? So again, here's what I showed him back then, addressing the first problem that he said. The first problem was I need $9 million. And here it was the spreadsheet. All my summaries showed me this. So here I'm showing you exactly the policies that he has. So he's got a Performax Gold, and that Performax Gold, at the time that we sold that illustration, it said that he'd have roughly about $2.6 million. That was the in-force illustration that was provided. The equitable policy that we were showing was an IFA, $250,000, 10 years of premium, death benefit of $5.2 million. But I incorrectly assumed that he'd have that $2.5 million of loan against the death benefit. How do I come up to $2.5 million? 250 times 10, all borrowed back is $2.5 million of loan. To my happiness, he doesn't have this. And his situation is more like my highest payout. And it's not like this was rocket science. I showed him this. And he says, okay, I get it, Frank. If the loan is at zero, we got $9 million covered, right? The 6.2 million is if he's got full leverage on the IFA, not full leverage, but just covering his premiums. Because of course, we all know that we can blow our brains out on an IFA and we can continue to borrow way past the premiums that we've put in because the cash surrender value, thank God, the policies just keep growing. I'm so sorry, Brad, I'm going to hurry up. But this is good because he knows he's got that $9 million covered. The insurance policy works for him. And now part of our review process was, let's just do an in-force illustration. Nothing's changing so far, but we want to make sure that our promise to you or the illustrations we showed you are on track. And thankfully, yeah, everything was on track. The presentations showed a little bit better than the original illustration. So fantastic. I see that we're at $9.2 million if we continue the way we do. But here's where we were able to satisfy that worry that he had. I have an offset of year 10. Why do we have to offset at year 10? So why can't we offset at year 20? Well, we all know if you continue to fund premium, that death benefit is going to continue to grow. So we've got that valve there to satisfy the growth that he has in his estate. So when I go through the numbers, what it shows me is that 20 years on that new policy we sold is going to give us a death benefit of $9.4 million. If it's all leveraged back, 9.4 million, scale back 5 million. So I've got at a low point 8 million and at a high point $13 million. So he's happy with all of this. And then the final thing I showed him is, oh, and by the way, that Performax, we've always been showing you an offset. What about if we keep funding for life? So if we keep funding for life, we squeeze out another $1 million of death benefit there. We also have a term rider. And that term rider, I think we have another 3, 4, 5 years. I'm not completely sure, but we have a few more years. But if all else fails and this gentleman wants more coverage because he's worried about outdoing his plan, we've got that as a lever as well. So I think that what this shows you is that, again, I didn't create rocket science here. to have that perfect review, but it was a good review because he came away with it. He sent me a thank you email afterwards saying that was so thorough and understandable. What was thorough? Like, how long did this take me? This took me no time at all to update. I don't want to say it took me no time, but if it took me a couple hours tops for a guy that's paying $250,000 a year, never missed a beat in terms of premium, and all of that is on the basis of we did the right job up front by producing that deliverable, that playbook. I swear by it. I swear by that thorough job up front to make sure that you have something on the back end to help the client in these times. So, Brad, I apologize. I'm a little
No
bit
worries.
over, but over to you. Don, I don't know if there's any questions, but I cringe because I don't want to take any more of.
No, actually, we're all they love the illustration and the simplicity of it, so that's fantastic. I guess the only thing that I'd ask you is that are you now going back with advisors from 5 years ago to update their files to see if situations have changed with their clients, or what's your process there to talk to an advisor and say, we saw this guy 5 years ago, where is he at? What are we doing?
So that's a good question, Don, because my answer is going to sound like a cop out. And the reason it sounds like a cop out is because I think Brad and I, and I'm sorry to speak for you, Brad, but I think that we're so busy and we assume that that client relationship and that advisor is on top of that. And they're going to nudge us to say, and in this case, it wasn't client reaching out to Frank, client reaching out to advisor.
Right.
And a lot of the advisors in this space, they want that control, rightly so. It's their client. Brad and I are going in as support functions. So the simple answer, Don, is that we expect that it's going to be the advisor that says, hey, Frank, can we reach out again? It's been 5 years. Hey, Brad, that wouldn't be me being proactive.
Yeah, I think the surprise here would be like he didn't exercise the IFA, so he didn't use the line of credit, but he could have. But had he used the line of credit, what would you have a solution there? Just buy more insurance to protect the line of credit as well?
Yeah, he is using it though, Don. He's using it, and he says to me, he goes, Frank, this is like a yo-yo. It's like a line of credit. He
Right.
said, truly, I use it like a line of credit. So his assumption, he says, I'm not tapping into it anywhere near where your numbers are at, Frank. So if when we die, I've got 1 million outstanding, he says, that's okay. Like at the end of the day, he says, if we needed 14 and there's 13, I'm okay with that.
Right.
But if we needed 14 or 15 and I'm at 10, I'm not okay with that.
Okay. Perfect.
Yeah, and I think I'll just jump in on that. And Frank, agree with you on that. In your client situation, he's really using it as a cash flow management tool,
Right.
right? It's not this typical IFA structure where you put it in place and you carry the loan forever, right? It's really cash flow management, which is much way I prefer to see them use it as well. So.
Yeah, yeah. So
Frank, I'm just going to thank you. I guess now that Brad's out here, I'll just thank you. And it was an excellent presentation as always. And Brad, we've got you on to take us to the farm estate planning and key considerations. So you're going to pick up the ball, I guess, where Frank kind of left it on the court.
All right. Can you guys see that okay?
We can.
All right. So yeah, so I really just, from my perspective, I wanted to touch on some of the key considerations as far as what Frank did is he talked about the case and where it got to and where it ended up. But how do we get there in the first place sometimes is some of that discussion around the key considerations. And the two that I want to hit on today is qualified farm property and the farm rollover provisions that are available and the farm equalization planning. So Frank talked about that farm equalization planning in there, and I'm just going to talk about some of the details around some of the things that I see when I'm dealing with farm clients. So when we talk about QFFP, what we're really talking about is qualified farm or fishery properties in the Income Tax Act. And in order to qualify for the use of the lifetime capital gains exemption, your asset has to be classified as a QFFP, right? And a lot of people will talk about it as QFP if we're just talking about a farm, or QFP if we're just talking about a fishery. But for the purposes of the Income Tax Act, it is QFFP, and the provisions relate similarly. So what is considered a qualified farm property, it kind of breaks down into a couple of categories, but really what your general consensus is the asset that I'm talking about, this qualified asset for the farm, is it used primarily in the business of farming, right? And that's the general rule that we want to make sure that we're starting with. We always want to go back and work with into a conversation with the accountants to make sure that the land or the farm corporation that we're dealing with is actually a qualified asset, because that's our starting point on whether or not we can use the capital gains exemption and whether the rollover provisions are going to apply or not apply. So that's the first step, is it a qualified farm property? And if it is, then we can talk about the use of the lifetime capital gains exemption. And when we're talking about the use of the lifetime capital gains exemption, really what we're trying to figure out how much of that exemption applies to the situation. And the thing to remember about the lifetime capital gains exemption is that it's per individual, right? So I'm just going to refer back to Frank's case a couple of times during this. It works out really well. So Bill and Mary, they would each have 1.25 million of capital gains exemption available to them, subject to the fact of they hadn't used any of their capital gains exemption previously. Okay, so if you've used some of your exemption in the past, then you reduce the amount that's available for the future because it is a lifetime capital gains exemption. Okay, the other thing that's coming up right now is we've got this 1.25 million that we've gone to, and it's going to start indexing again starting in 2026. So what that means is that if I use up my exemption today, starting in 2026, I'm getting a little bit more exemption each year on top of that 1.25 million that I might be able to make use of in the future. So in Frank's case, we were talking about, maybe planning out 20 years, what's going to happen in 20 years. Well, with indexing, as long as we don't have changes again in how the capital gains exemption is being indexed or what the numbers are going to be, we may have some more exemption that we can use at that point in time. So again, we can do capital gains exemption. We can use it on multiple transactions during your lifetime. It could all be used in one exemption at one point in time. So in Frank's example, when he was talking about exchanging shares and going to those preferred shares in his original discussion in 2021, they would have opted to either use their capital gains exemption at that point in time to lock it in. If the company qualified at that point in time, that would be a perfect time to make use of it and lock it in. At the time, we didn't have 1.25 million. We were probably at a million at that point in time. So we would have an additional 250 now to use. So there's some things that we can use around that capital gains exemption. The biggest thing that we want to make sure that we understand is that it's being tracked by the accountant that's working on the file for the client. And so that's what I'll say about the lifetime capital gains exemption in the use of it. Now, as far as what the value of it is, it's significant if it can be used. And this is why we try and make use of it, particularly with farm files, because it's a little easier to qualify for use on the farm. And we've got depending on the structure. So as Frank was talking about his case, he said that they rolled everything up into the farm corporation. Sometimes the challenge with rolling everything up into the corporation is if we have a bunch of other assets in the corporation and those assets are not farming assets and they're passive assets, we can actually lose use of the capital gains exemption qualification. So sometimes what we see is we see farm land, which is always used in the business of farm, left out of the corporation, and we use the exemptions against the farm land. And then we have the farm corporation that wouldn't maybe qualify. Again, we've got to look at that qualification of how we're using it and what we're using it against. Is it shares in a corporation or is it against personal assets? But let's assume that we had a $2 million capital gain and we had full use of the LCGE, the capital gains exemption. So really what we're doing is we're saying the capital gain is reduced to 750,000. And then we have our capital gains inclusion rate, which is today 50%. So 375,000 at that point, that time of calculation for the capital gains tax, 375,000 would be included in income in that year. So that's how we would do it. Without use of the exemption, we're just a $2 million gain, of which 50% is taxable. Now I'm including $1 million in my taxable income. So you can see there's quite a bit of a difference in what I'm going to pay tax on by using the exemption or not using the exemption. Once we get into much bigger capital gains, the impact of it feels less.
Mhm.
So, if I had a 20 million or a $50 million asset, as Frank was explaining, the difference between using the exemption and not using the exemption isn't as significant as it is on smaller capital gains. Okay. So that's the capital gains exemption. And really the reason why we want to understand it is when you're talking about qualified farm assets, what are the provisions that we can use when we're transferring those assets down to the next generation? So in Frank's example, where he transferred the shares to Mary's children, her daughters, those shares could have been retained there, but it's not ideal because if those shares are retained there, then I've got ownership in the farm corporation that is split between the person that's farming and three non-farming owners. And that can cause a lot of issues for the management and the running of the farm. So we typically want to get the non-farming children out of the farm, right? And so this is where we are going to use different provisions like what Frank explained there. But let's say that we didn't use any of the insurance and we didn't have any of that planning that Frank's done there, which is great planning from an insurance perspective, but also from the farm ongoing perspective. Let's say that none of that was in place. What we oftentimes hear from accountants is that we don't have to do all of this planning because we can just use the farm rollover provisions. And what the farm rollover provisions say is that if I'm transferring assets to the next generation, as long as that's a child or a grandchild or a great grandchild or a stepchild or a child in law of spouses of eligible children, I can roll those assets to that group without any taxation. Okay, so it's only on qualified farm and fishery properties that I can do this. And it's a provision that gets overused in my opinion, because should you be rolling these things to that next generation without paying your tax on what you did, and how does that affect the farm operation moving forward? So it's always on an individual basis that we have to look at these things, but we don't have perfect provisions for rollover. So what can be rolled over is qualified land, qualified depreciable property, qualified interest in a family farm partnership or a family farm corporation. So in Frank's situation, all of the assets were in that corporation. So we've got that rollover provision that we could use as long as that farm corporation is a qualified farm company. Okay.
Brad, let me stop you just for a second. So, as I'm
Yeah.
sitting here thinking about it, in Frank's case, Bill's son was taking over the farm. There was three daughters there. If there's
Mhm.
no insurance in place, and now all of a sudden these daughters inherit their share, I guess, if you call it their share of the
Yeah.
farm, then the
Yeah.
son, who has no money, has to buy out those sisters-in-law, I guess, stepsisters.
Yeah. Yeah.
And do you run into that a lot?
Yeah, more often than you think, actually, because most people don't do this planning. And
Right,
so what happens is the wills generally will stipulate that all assets are transferred in equal shares to my children. And those
right,
children usually include the stepchildren.
right.
So very frequently we see this lack of planning done. And that's where, bringing Frank or I or Chris into the equation and having the discussions really sheds a lot of light onto what's actually going to happen, right? And
Mm,
that's so key in the planning, because when we shed light on what's going to actually happen, we can also shed light on how do we solve that problem, right? Go
the
ahead.
other,
And
the other
just
thing,
quick,
sorry, go ahead, Frank. Go ahead, Frank.
I just want to quickly step in. I want to stress this is paramount in farm corporations, but guess what? Every corporation you have out there faces that same issue that you just mentioned, Don.
Right,
It's why I think life insurance is the best tool to keep families loving each other.
right,
Because we could have a machine shop in Vaughan, Ontario, that's worth the same numbers, 20 million, $30 million. Maybe one of the daughters takes over. And actually, one of my first cases that I worked on way back in '05 was a situation like that. Daughter was taking over the machine shop. Sons didn't want anything to do with it. And the insurance and the premium, the dad looked at the daughter and said, it's a hefty premium, but it's your buyout of your brothers.
right.
Right at the end of the day, he's told them, he says, I'm freezing my shares, and your brothers are going to get a piece of what I've worked all my life to get. Whatever
Mhm.
you take this company to over and above is yours. You're going to have the common shares. But I just thought, wow, this is exactly why I do what I do, is so that I've got that insurance solution. And it was an easy decision. She looked at it and said, yeah, I'm going to pay the premiums to buy out my brothers. I don't want them sniffing around my corporation when you're gone, Dad.
Right.
So
Yeah, I'm
sorry to
surprised. I'm
jump in.
surprised your phone isn't ringing off the wall with all of our advisors coming to see you about this. Because the other thing that comes to mind is that I'm down here in Niagara, and there's a lot of now maybe they don't qualify, but do wineries qualify as a farm? Would that be considered farm property, or would that be what's the situation there?
Yeah,
What is a
yeah.
qualified farm? Like, what do you mean? Is it a marijuana farm? Is it a farm farm? Or what kind of farm are we talking?
Yeah, as long as it's qualified under the farm rollover, or sorry, the farm rules, right? So
Right.
what is a qualified asset as a farm? Well, farmland is, am I growing something on that land, and am I taking that crop and am I selling it, right? So
So would a horse ranch though, if I have a bunch of horses and I'm in Woodbridge, would that be farmland? Would that be considered a farm enterprise?
well, again, it depends on what I'm using those horses for, right?
Okay,
So
racing.
am I just grazing on my land,
Right, right,
and I'm
right,
just riding them personally? Then it's not a farm,
right.
right? But if it's, am I raising those horses to sell, and am I raising those horses to do something else? Then yes, that is qualified farm, right? So again, we have to really work with the farmer to understand what's qualified, what's not qualified, and I can say that, you know, I would say, I don't know, maybe Frank, you got a different number on this, but I'd say 95% of the advisors that we work with don't really have the qualification to determine whether or not that's a
Farm.
qualified farm.
Right. Well, it's a matter of fact, before I even saw this question, here's the question. Is there a standard definition of a farm, and how does it distinguish from a principal residence? So back in the day when I lived on a farm, we had a farm. I think it was the farmhouse and like 5 acres surrounding the house that was considered, exempt or not part of the farm. And you couldn't sever property. So just because you have a 3,000 acre farm doesn't mean the daughters get, 1,000 acres, 1,000 acres, and 1,000 acres, because you have to go through the separation of that property, and you might not in your municipality be able to separate that and build a house on that property. That's the first thing. Second thing is, we've bought property in a farming area, and we're told that since our residence, only 1 hectare forms the principal residence exemption. So exactly what I was just saying.
Yeah.
Yeah, so again, that comes down to what's your land makeup, and what's the organization of the farm, and what are qualified farm assets versus principal residence exempt assets,
Right.
right? So all of that has to be reviewed as part of our planning process. And that's what Frank and I and Chris do, right? Is we look at all of those details and help determine what needs to be taxable, or what's going to be taxable, what's not going to be taxable, and then apply all of the rules that we're talking about to determine what insurance should we be putting in place so that the family is going to have the least amount of burden for paying tax. I use its terminology. It's really simple. I
Mhm.
say, if you have a tax problem that costs $1, do you want to pay more than $1 or less than $1 to solve the problem?
Right.
right? And everybody says less than $1.
Right.
Okay, well now I know immediately that we're going to be talking about insurance because it's the only way to solve the problem for less than $1,
Okay.
right? So we have to identify though what the problem is. What we quantify what that dollar looks like. And that's probably the most important part of our role because it's the justification for the insurance, which Frank said as he talked about in his presentation. Once you've done that with the client and they understand why they're buying the insurance, it's to cover that tax liability, and
Mhm.
that tax liability is going to be significantly lower, or it's to buy out shares, and that problem is $1, right? Well, where do I get the dollar from? Right? I'd rather
Well,
pay less than the dollar to get that dollar paid out. Right?
one suggestion from one of the advisors is to ask your accountant, as it's a tax question. I said, well, the difficulty there I find is that an accountant from, and I'm not going to belittle, and my parents are from, my dad's from Yorkton, Saskatchewan. So an accountant in Yorkton, Saskatchewan would be much more aware of the rules regarding what you're talking about, as you are, Brad, than a downtown accountant or lawyer in downtown Toronto. Would that be fair to say? Do you look for a specific accountant for those kinds of situations?
Yeah, I think most accountants are going to be able to pick up on the rules easy enough. I don't think it's a blanket statement where we can say a rural versus a an urban accountant is going to know more about this than the other. I mean, I have lots of urban accountants here in Edmonton that are very familiar with the farm provision rules because the large farms that we deal with are coming into town to deal with those issues.
Right,
So I wouldn't blanket that. What I would say is that not all accountants are planners.
right.
A lot of accountants are just filing the annual taxes and filing the annual provisions that have to happen on a tax basis annually. They're not looking necessarily at the long-term planning, and that's where we really bridge that gap, right? Is we
Hmm.
can really help people understand what that long-term planning needs to be and work with the accountant that they already have to help them do that planning. I my experience has been that most accountants love when we're involved,
Right,
right? Because we're doing a bunch of the work that they can't get to or that they don't have the expertise for,
right.
right? And so they're quite happy to work with us. I just want to cover one more thing
Sure, go ahead. Yep.
on this side of things. You know, on the farm rollover provisions, one of the things I say is just because you can roll the assets without paying tax doesn't mean you should, right? And so a lot of the times using the farm rollover provisions, we don't have to pay the tax. We can just roll it to the next generation. But I look at this as an example. I mean, I had a client that purchased some land in 1990 for $200,000 for five quarter sections of land, and then in 2025, those assets for those five quarters are now worth 5 million.
Right,
So we're rolling way more than the capital gains exemption can take care of. So
hmm,
now I'm giving my tax liability to my kids,
right,
right? And that's the discussion that I have with farmers. Do you want to give your tax liability to your kids, or do you want to take care of it yourself? And
right,
these are all just questions. They're not, this is whether you have to do it, right? But a lot of times it's not questions that get asked. Right. So that's on the farm rollover provisions. And then, of course, we talked about the equalization issue here in Frank's example. So I'm not going to beat this drum too hard, but one of the things that I always say is if we give farming assets to non-farming children, we can actually encumber the farmer from doing the role that he's trying to accomplish. And I'm going to use an example of this because I had this happen with a client. They gave all the land base equally between their children. They had four children, one farming, three non-farming. So very similar to Frank's case. The farming child now owns 25% of the land base in ownership, and the three non-farming children that have nothing to do with the farm own 75%. And the farming child went to get a farm credit loan to put seed in the ground and was told you have to get sign off from
hmm,
your other owners because you don't own the land that we're signing off against as
right,
collateral for that loan. So that creates some issues, right? And we want to always have family harmony, as Frank was talking about. So it's much better to pay out the non-farming children and get them out of the farming operation than it is to leave them in it. And it's just helping the farming families understand that. Those were it for me.
Good. Just a little from all the questions, I guess it's a little over time, so that's perfect. Brad, again, I'm so glad that you guys are so good because you, Chris, and Frank are just amazing. And I think that obviously I know you're swamped now these days with ongoing projects and work that you're working on, but there's no end to the possibility of the kind of work that you do for these advisors. So I appreciate your help, and I know the advisors do as well. And thanks for your help today.
Right. Thanks, guys.
Thanks, Tom.